Hey, what's up guys? This is Juan Pablo from 100% Finance at 100%finance.com. Mr. Passive Income, Mr. Cash Flow, Mr. I got what you need to succeed because I'm teaching you in the classroom. Alright, I'm going to stop rhyming because one of my subscribers says I need to stop. So I'll take heed to his instructions. You got me? But today's topic, I'm going to discuss analyzing a multifamily deal. So this spreadsheet, which you're looking at, you're now looking at me, this video. But this video, I wanted to record a spreadsheet on my computer. If I knew how to do a screenshot and do it, I would. So if one of you guys out there who are my subscribers or viewers on YouTube, if you know how, please send me the information so I can make a better quality video for you guys. Alright, but right now I'm just going to use what I know and use what I have, okay? So this is a 6-unit that I am buying. Right now we have under contract, and this is the financials. I have this cash flow analysis spreadsheet. It's called Buy This Property or Not. If you go to 100% Finance, go to the Valuable Resources page and scroll down to the bottom where you see free documents, and you'll see the spreadsheet where you can enter in some information. So for this deal, I doctored it up to kind of omit any type of, identifying information like the street address or some of the information from the owner. I omitted that information, all right? But I just left the actual numbers here. So this is a 6-unit multifamily building that I'm buying with a partner, and we're not using our own cash. We're using 100% financing. So the reason why I partner on this deal is, for one, he has a private money lender who's willing to lend $20,000, okay? And I negotiated with the seller to give us the financing, seller financing at 10%, okay? So I'm gonna go over the numbers, and hopefully I'll go slowly. If I go over anything you don't understand, just send me an email and I'll do my best to explain it, okay? So here we go. So here's the mouse in the upper left hand corner. The asking price was $160,000. Again, we have under contract, we're under the due diligence period, so we didn't order the appraisal yet, okay? What we did so far is we incorporated a limited partnership in LP between my partner and I. And once that's done, we'll order the appraisal, but right now we're just, again, under the due diligence period. I negotiated to the seller. I met with the seller in person. He's an older guy, ready to retire, and wants to sell the property. So I negotiated the purchase price to $147,500, $147,500. Got it. Getting tongue-tied over here. So we lowered the purchase price some. In the best scenario, I should say this, the three things you always need when purchasing a multifamily property is, one, it has the cash flow, meaning your gross income minus all your expenses, there has to be a profit. 2, you want to have a rate of return, and hopefully you'll be infinite if you get it 100% financed because none of your money's in a deal. So that means you're making money off of someone else's money. One of my philosophies is use your own money to have fun with. Use someone else's money to get rich. Okay, so that's rule number 2. And rule number 3 is you want to have built-in equity. So that's why I mentioned that. You want to have built-in equity or upswing for appreciation. At least you want to have about, if you can swing it, 20% built-in equity. In this deal we don't, but it's all right. And the reason why you want that is for refinancing purposes, so you can pay off the down payment if you borrowed it. Okay, so the purchase price is $147,500, which our lender requires a 20% down payment, so that leaves about $29,500 we have to come up with for the down payment. So here's the bank financing. Our bank will finance $118,000. So the main thing right here is the $29,500. Are we coming out of pocket with that? No, because that's not what we do at 100%finance.com. What we do is we get 100% financing, right? So how are we going to get that financing? Over here, here's a quick reference guide on the spreadsheet for 100% financing. We got the bank loan for 80%, which is $118,000, and it's 5% interest rate, amortized over 20 years, will give us a monthly payment. That's what PMT stands for, monthly payment of $776. We'll have to pay the bank every month. The seller, sweet talk the seller, because when you meet with the seller, of course you want to create rapport with the guy and see his motive for selling, to see how you can benefit him and yet benefit yourself. So even though I told the realtor, ask the seller if he'll accept a no for 10%. And the realtor was like, come on, Juan, you already said you'll do the deal. Now you're going back and saying this, you bring another thing to the table, blah, blah, blah. I'm like, listen, man, the guy is retired. He has other sources of income. He might not miss 10% of that money. He might be willing to say, okay, I'll take 90% of the money, and then you can pay me the other 10% at a later time with interest. And he accepted. I pitched him 5% interest. I guess the standard to pitch to sellers for seller financing is about 5% interest rate, interest only payments for 5 years with a balloon payment at the end of 5 years. He said, oh, I'll do it for 6% for the end of 5 years. Okay, so that comes out to a monthly payment of $73. That's just interest only. So at the end of 5 years, we'll owe him a balloon payment of $14,750. Okay. Now we also have a private money lender. So my partner, that's why I'm partnering with him, he knows someone who's willing to give $20,000 at a 5% interest rate, interest only, amortizing 5 years as well. That comes out to a monthly payment of $82 per month. Okay, so that's 100% financing right there, people. Okay, a little more than what we needed. Okay, so let's go to cash needed at closing. The down payment that we have to come up with is just 10%. It's supposed to be 20%, but remember the seller is holding a note for 10%, so that leaves a remainder of 10%. And that's what I put right here. Okay, you can't read that, but if you want, I can email you the spreadsheet. I'm going to email it to my subscribers with this video, and then you can click on the spreadsheet yourself and read all this stuff. But basically what I have here is sellers financing 10%, so we have to come up with the other 10%. That's what it says right here. Alright, so the property inspection is going to be $990 for the 6 unit. The appraisals, we didn't order yet, but I assume it's going to be about $600. Closing costs, I put it at 3.5% of the purchase price, which would be about $3,500. Repairs, upgrades, as you see here, we didn't order the property inspection yet, so we don't know where repairs are needed, but we'll try to have the seller fix them. And there's some other strategies to have the seller fix them. I did a YouTube video about it last week, so just check that out. And reserves, we want to have about 4,000 reserves, which is about 2 months of operating expenses at closing. So in our savings account for reserves, we'll have 4,000 just for any type of maintenance or vacancy issue right up front. Okay, so you always want to have reserves up front, at least 2 months, because you never know what can happen, right? Just to play it safe. So the cash we need at closing is $23,880. All right, so we already got $20,000 here, right, from a private money lender. So that means if the seller is financing $14,750 and the private money lender is financing $20,000, the partners, myself and my other partner, need to come up with $3,880 by closing. Okay, so how are we coming up with this $3,880? Well, me, I'm not coming up with anything since I found the deal, since I'm doing all the sweat equity and will be managing the deal. I'm not coming out with a single penny out of my pocket, but my partner will. So my partner is bringing the $3,880 to the table, as well as the private money to the table. Okay, what I brought to the table is the seller financing, found the deal, and I'll be syndicating this whole ordeal, as well as doing all the work, sweat equity. Okay, so it's a good trade-off, and we'll be splitting the profits 50-50. All right, so that's the total cash needed at closing, but my partner will come up with about $4,000. All right, so that's what's needed at closing. Okay. And what we're going to give for the seller financing, he's going to hold a second mortgage or a junior mortgage, a junior lien, whatever you want to call it. And our mortgage banker will hold the first mortgage, the seller will hold the second mortgage. And the private money lender is just getting a promissory note. And we also have promissory notes. If you go to our valuable resources page, people, I put a lot of free useful documents there, so make sure you get access to it, okay? You can access this exact spreadsheet. Plus, you can access the promissory note. And again, it's just samples here. All right, you should always have an attorney drafted for you just to make sure it's legit, but just give you a gist of what it's about. Okay, so rental income. The rental income from the property, I verified this through the leases. So normally I ask to receive the seller's information, such as copies of the leases, the rent roll, which just shows the amount of rents and security deposits paid by the tenants every month for the past year or two. As for the seller's tax returns reflecting operating expenses on his tax return. So that way, you know, whatever's on the listing, which is basically a list of financials that the realtor gives you about the property. I want to make sure that matches up with the seller's operating expenses that he declared on his taxes, because they should be the same, right? If not, if there's some differences, you want the seller to explain why. Okay, so I'm gonna scroll down. So the rental income is $2,750. We verified that through the leases. There's no other income. Other income can be from coin laundry or having a billboard on top of the roof or cell phone towers and things like that, or paying for parking or vending machines. There's other ways to get other income. So one of the things I propose to increase the added income, other income, is by having a coin laundry in the basement. There's 6 units. We can put just one wash machine and dryer and charge them perhaps I don't know, $1.50 to wash and 75 cents to dry or something like that. Okay, so right now the rental income we receive on a monthly basis, again all these numbers are monthly totals from here on down for the income expenses, is $27,500. Okay, so I'm gonna scroll down. Okay, so the bank loan, which I told you up front, is $776. It's the principal and interest amortized over 20 years, 5% interest rate. Seller financing is just interest only, you know, 6%. 5-year balloon payment is $73 a month. Private money is 5% interest rate. 5-year balloon payment is $82 a month. Okay, so that's our debt service. So that's why it's a different color if you can see it. These 3 items. All this is your debt service. It's the debt that you borrow to service this property, okay? And now from here on out, so this really, the debt service shouldn't be under expenses, okay? This should be separate. But I just put it under one account just to make the math easy. This is subtract the income, just so I can subtract the income from the expenses. But these top 3 items should really be debt service, okay? Don't want to confuse you, but I have an Excel spreadsheet, just makes the formulas a little easier. Okay, now we're going to the real estate taxes. They're $250 a month. And originally on the listing it said $400, but when I verified, since I received the seller's paperwork verifying he paid his taxes for 2014, and also always check the local municipality website. They have something called the millage rate, and based upon the property assessed value that the county or the local municipality comes up with, you multiply that by the millage rate for the school taxes, the county taxes, as well as for the local municipality tax, and you get that figure yourself. So it came out actually less than what he had on the listing, which is strange. It was $250. So I put that there. So here's something I want to mention. Always trust but verify. Always trust but verify. So you trust what's on the listing, but you verify everything. So I called the tax office as well, look at the documents, look at the website. Insurance, I sent my insurance broker a quote, and they came back at $94, which was also less than what the seller was paying for insurance. Since I went to the website of the local municipality, I called them and asked them questions about licensings and rental properties and whether there are ordinances and things like that. And they say, oh, they charge a couple dollars per month per unit, blah, blah, blah. So it came out to $15 per month. And the inspector will inspect the property, every unit, every 2 years. So that means we have to save $15 a month to go towards that for the seller to make his inspections. The water bill is in blue. It's about $350 a month. It's higher than what was on the listing sheet, but I'm waiting to hear back from a representative to verify this amount. I couldn't get in touch with them, that's why it's in blue. Okay. Electric is about $140 a month, and this is just general electric stuff. It's water for the whole building. Electric, I think it's just general. It's a little high. Gas is $59, almost $60 a month, which is just general house bill stuff. Reserves. You always want to have reserves, people. That's where a lot of real estate investors mess up. They don't have adequate reserves. For older property, I normally have reserves for maintenance, either 10% of the gross rents or 15%. But for this property, since it looked well maintained when I viewed the property myself with my eyes, even though I didn't get a property inspection yet, I'm still going to order a property inspection because I'm not a professional there. But with my eyes, it looked pretty well kept, in decent shape. I allocated $275 a month, which is roughly 10%, like I said, of the gross monthly rents, which is $27.50. So that's how I came up to $275. And again, we started off with reserves with $4,000 at closing. So every month for maintenance, we're going to be adding $275 to that pot. So every month that $4,000 is going to be growing by $275. But wait, there's more. It will also be growing by an additional $137 per month. This is a vacancy reserve. So I allocate about 5% of the gross rents to vacancies. So 5% of $2,750, which is the rental income every month, is $137. So every month, $275 for maintenance plus $137 for vacancies plus 15 bucks or whatever for the borough fees for inspections will be added to that $4,000 initial reserve. Okay, so we're really going to be building a pot there. And the trash bill is about $89 a month. It's in blue because I haven't verified it yet. So it just gives me a quick visual that I need to verify these two pieces of information. So from the onset, it looks like the total expenses are $2,340. Okay, so our monthly cash flow is about $410. So what you do is you always look for ways to increase your revenue and decrease your expenses. That's how you increase your profit. As a business person, you should always focus on improving or increasing your profit. So one of the things I plan to do to improve the profit is that 3 of the units are under rented. Okay, so some of the tenants been living there 5 years or longer, they're going to get rent increases. And if they're not happy with it, then they can move out and I'll place a tenant in there that's paying market rent. So that's one way to approach this profitability concern, because it's always a two-pronged attack, right? A two-pronged approach. Increasing the revenue and decreasing expenses. So that's one way to increase the revenue. It's giving the tenants rent increases as well as adding coin laundry. Okay, so a way to reduce the expenses is for the water bill, we can add water conservation kits, which is basically, I don't know if some of you done this, but you know how you get like a soda bottle and you put rocks in it, you put it in the toilet tank, so it fills up the water faster, that reduces your water bill, and just update some things, because there may be some things in there like the water tank or whatever that's inefficient. So we'll look at things like that to reduce the expenses. The electric, we can probably, for the hall lights, add energy efficient light bulbs. Gas is relatively low, there's not much we can do there. But we can always contest the taxes as well. Try to lower the assessed value if it's assessed even higher. I didn't even look into that yet, but it just came to mind just now. So those are ways to reduce the expenses. Reducing the water bill, reducing the electric bill, and reducing the taxes, okay? So the cash flow comes out to $410 a month. Woohoo! You might say that's not much, but actually it's pretty good. You're getting $410 and you're not even putting one single penny of your own money into the deal. That's what I call 100% financing, people. So now that's our yearly cash flow right there. This gives us about a 21% rate of return on our money, by the way. So I'm scrolling down a little bit. So one of the things you want to talk about or think about is exit strategies. You want to figure out, how am I going to pay off the seller financing? Because I owe that guy, the seller, $14,750, which will be payable or which is due in 5 years. And then you want to ask yourself, okay, how am I going to pay off the private money lender as well? Because I owe him $20,000 in 5 years. So both of these guys need to be paid off at the end of 5 years. So that's $34,750. So you always want to consider, when it comes to exit strategies, the back door every single time you're coming through the front door. So before you even close, you want to have at least 3 different ways you can exit out. Whether it's the window, whether it's the back door, or whatever. You want to have 3 or 4 different options. So this is how we intend to pay off the seller financing private money. First thing we can do is we can pay off the lenders, the seller financing and the private money with the cash flow. So instead of eating or consuming the $410 a month in cash flow, we don't. We just add it to the reserves. Okay? So within about 36 months, we'll be able to pay off the seller with seller financing through the cash flow. And then with an additional 42 payments or 42 months, we can pay off the private money lender with the help of using the reserves. Let's say that we continue to maintain a property and use that money for the reserves or making big expenses, we can pay off both of them in less than 5 years, just from the cash flow and using a little bit of the reserves. Okay. Second option is we can pay off both lenders through a cash out refinance. So let's say before the end of maturity of 5 years, we have over 20% built-in equity. Okay, so we bought the property of $147,500, and let's say we had built-in equity. What we can do is do a cash out refinance, and we can pay off, the private money as well as the seller financing with the cash out refinance, and also maybe through the reserves and or through the cash flow as well before 5 years. Okay, so that's why you want to buy the property with built-in equity. Okay, and if it has a positive appreciation. Another way we can do, we can pay off the lenders is with the reserves. Let's say we're adding to the pot $275 a month plus an additional $137 per month plus $4,000 initially. We can use some of those reserves to pay it off. Probably not all of it, but a good chunk of it. And 4, we can pay both lenders off if we sell the property in 5 years. So we pay them off, and what we can do is we can just realize the capital gains, and or if we still have money left over in the reserves, that would just be our profit that we just keep after 5 years. So you see, we have about 4 different ways of paying off these lenders. Okay, and at the bottom of the spreadsheet, it's just some assumptions that you put in there. Interest rate for the mortgage, investor, down payment, stuff like that. So I hope this video was useful. This is the actual deal I'm doing, and just wanted to share with you guys and have you guys look at my computer screen. So just make sure you go to the website, see at the bottom, 100%finance.com, and you can download the spreadsheet. But if you're on YouTube and you're not yet a subscriber, make sure you subscribe and email me so I can give you the spreadsheet so you can follow along with this video and it makes sense. And if it doesn't make that much sense, contact me and I'll do my best to help you out. I also provide coaching as well, so I can coach you through how to get your own multifamily properties or rental properties using hard money, using business credit, using seller financing, using private money, using a gauntlet of different ways of getting a deal done the 100% finance way. Alright, so make sure you check out the website on the homepage. It tells you about coaching as well as getting business credit, credit repair, things like that. So I help you through all that. Being motivated, staying accountable. Okay, and at the top is property information. Again, I left this blank because I want you to know the exact deal I have, but it gives information like the type of property, the address, as well as when it was listed, the website for the listing, the contact information with the realtor's information or the seller's information. And you always want to get the seller's information because best case scenario, you want to have a great rapport with the seller so you can kind of sweet talk him or her, and you can get better terms that way. It has the square footage, how old the property is, and the email of the contact person. Alright, so this is the cash flow analysis. Oh yeah, and up top, before I forget, here it is, to buy this property or not. There's the cash flow. And again, some of the stuff is formless. As soon as you put a number in, it just populates automatically. This is the rate of return. But if you guys are smart, you guys already know, which you are smart, the rate of return is really not 21%. It is really infinite. Why? Because we have none of our cash in the deal. Well, my partner does. So his rate of return is even higher than 21%. But my return is infinite because none of my money will be in this deal. Okay? So, oh, and I also didn't add in attorney fees. So you also got to add in attorney fees down here. Cash needed at closing and stuff like that, if you want to add that in there to incorporate an entity for you and your partner. Alright, so this video is pretty long, but I hope it was very useful to you guys. My name is Juan Pablo. Make sure you watch my other videos. You can buy my ebooks on multifamily investing. I have an ebook on that. It's all on my homepage, as well as wholesaling if you have no cash and credit, doing flips with no money down, and buying whole properties the 100% finance way. So I'm Juan Pablo. I'm out. As always, this is to your success. Be blessed out there, people. Thanks again for watching. All right, bye.